This video is for Chapter 14, which is on long-term liabilities. So Chapter 11 was short-term liabilities or current liabilities, and Chapter 14 is on long-term liabilities. So the primary two long-term liabilities that we're going to be talking about are notes payable and bonds payable. So you just got finished reviewing Chapter 13, which was on corporations and how corporations raise money. And there are lots of reasons why a company wants to raise money. And primarily they want to finance their growth. So they want the company to grow and earn more money and more money and more money. So one way to do that, which we saw in Chapter 13, was to issue stock, either common or preferred stock. And so that's equity. We can finance growth with equity. You can also finance growth with debt. So when a company looks at their options for how they are going to raise money if they need money, they have a few options. So they can just purchase items on account, which is accounts payable. They can issue debt, which is the subject of this chapter, using notes payable or bonds payable. And here, if they issue debt, they have to pay interest to who they're borrowing it from. And then in Chapter 13, we saw that we can issue common or preferred stock. Now, if we do this, we have to pay our stockholders dividends. So we have to look at, well, how can you tell which one's the best option? If we know we got to raise money, which one is the best? Well, one way to measure which option is the best is a calculation called earnings per share, or we'll abbreviate EPS. And what we're going to do is we're going to take net income of our company after we've run through this particular option, subtract out any dividends that we need to pay, and divide it by the number of common shares that our company has outstanding. So that's what that OS is, outstanding. And we're going to get earnings per share of the company, and then whichever option has the highest earnings per share is the best option. So here's an example. We have a company called Boz Corporation, and Boz needs $4 million to finance some opportunity. Either we're going to start a new location, we're going to start a new product line, we're going to grow in some way. And we've got 3 plans to raise $4 million. Plan number 1, we issue all common stock at $10 par. That's $4 million. Plan 2, we'll raise 2 of it using preferred stock and the other 2 using common stock. And plan 3, we raise $2 million of it with bonds, $1 million of it with preferred stock, and $1 million of it with common stock. So let's analyze each plan, okay? So in this first plan, we're going to have no bonds, no preferred stock, and all $4 million is common stock, okay? This plan 2, no bonds, $2 million of preferred stock, $2 million common stock. And the last plan, we're going to get $2 million of bonds, $1 million and $1 million from our different classes of stock. So in all of these situations, we have a plan for $4 million. And, you know, different elements cost us money. So in this scenario, we're going to look at earnings before taxes. So that's what EBT stands for, earnings before taxes. Because depending on what we have to pay, so if we have to pay dividends, those come straight out of equity, and they're not going to affect our net income or our taxes. But if we have to pay interest, we actually get to expense that on our income statement, and that will reduce our taxes. So we're going to start with our net income or earnings before taxes because the taxes that we will owe will change depending on the plan. So in Plan 1, we have no bonds. And bonds is the only type of financing here that will cost us interest. So we won't have any interest. So we'll have $800,000 of earnings before interest and taxes. I forgot the I, interest and taxes. And so the interest will be zero. So we still have $800,000. Now let's calculate the tax. So we didn't get to deduct any interest since we didn't have any bonds. So 0.40, 40%, times 800,000 is 320,000. And we're going to subtract that from our net income because we have to pay the IRS that money and we don't get to keep it. So we have net income of 480,000 after we pay our taxes. Since we don't have any preferred, so we don't have any bonds and we don't have any preferred stock here, we don't have any preferred dividends to pay. So what we have remaining to pay our common stockholders is $480,000. So let's calculate earnings per share. Earnings per share is net income minus preferred dividends over number of common shares outstanding. So net income here is 480 minus 0 because we didn't have any preferred dividends. And that is, well, we have to figure out the number of shares. So let's come over here and say, how many shares is this? Well, if we're going to raise $4 million and it's $10 par, 4 million divided by 10 is 400,000 shares. So we would have to issue 400,000 shares to get $4 million. So that's your denominator. So your earnings per share in this first plan is $1.20. Okay, let's look at Plan 2. So Plan 2, we still don't have any bonds, so we won't have any interest to pay. And we'll have to pay the same 40% tax. So we'll have the same net income. Now, because we have preferred dividends, or preferred stock rather, because we have preferred stock in this scenario, we are going to have to pay dividends. So how many shares is this 2 million here? Well, if we want to raise $2 million from preferred stock, we have to divide it by the par. Oops, I'm on the wrong one. 50. So divide it by 50. Then that should be 40,000 shares. Okay, so this represents 40,000 shares. Well, then what is a 9% dividend? Well, 50 times 9% is $4.50 per share. So you take 450 times the 40,000 shares, and that is 180,000 in dividends. Okay, so that's 180,000 that we're going to subtract out, and then the dividends available to pay our common stockholders is 300,000. So that's really the numerator. So 480 minus our preferred dividends is the 300,000, then divided by the number of preferred shares. So that was, well, we have to figure that out. So come on up here, and now we're looking at common shares because our denominator that we need to divide our earnings per share calculation by is the common shares. And in this scenario, we have 2 million of common that we need to get divided by $10 par. That's 200,000 shares. So half as much as the first plan, because in the first plan we got all 4 million from common stock. So that would have been 400,000 shares. Second scenario, we're getting half of that. So that makes sense. That's 200,000 shares at the bottom here on the denominator. And so that earnings per share works out to be $1.50. So a little bit better than Plan 1 because we want our earnings per share to be the absolute highest that it can be. So let's work Plan 3. Now Plan 3 is we've got a little bit of everything. So we're going to start out with $800,000 and subtract out our interest. Well, if we're going to have $2 million of bonds, we have to pay our bondholders 12% interest on that money. So 2 million times 12% is 240,000 that we're going to have to pay them for borrowing that money. And then 560 is now what we have left over to pay our taxes. So you take 560 times 40% is going to be our taxes. And now we have net income of 336. And we have some preferred shareholders again. So let's go up here and figure out. We have the 9% again, which is $4.50 per share, times the number of shares. Well, we have $1 million of preferred divided by par is 20,000 shares. So you're going to multiply that times 20,000, and that is $90,000 in dividends. So let's subtract that out. 246 is the amount available to pay common stockholders. So 336 minus the 90 is 246 in your numerator. And then our common shares will be this 1 million that we're going to get from Plan 3 divided by 10 is 100,000 shares of common stock. So that'll be your denominator. So you actually get $2.46 if you go with Plan 3. So we're actually going to go for Plan 3. Plan 3 wins out because it had the highest earnings per share. And really the main reason is we got this benefit of an interest deduction that saved us some taxes, and that left some more available for our common shareholders. So now what I'm going to do is we're going to go in depth a little bit more about bonds. So bonds are very similar to notes that you've already learned how to calculate interest. So that's going to come in handy here. Bonds are contracts, and so they're going to have a face amount, just like a note does. It's also going to have proceeds that we receive from our bond holders. So we're going to give our bond holders who are going to give us money, we're going to give them a piece of paper that's a contract, and we promise to pay them back. Those are our proceeds that we receive from them. And usually bonds are in increments of 100, 1,000, or 10,000 increments. Bondholders are like stockholders. They're the ones giving us the money, except instead of owning the company owes bondholders. So bondholders are really creditors to the company. We're going to pay them interest for letting us borrow the money, and we're either going to pay them annually, so once a year, or semi-annually, which is twice a year. Each bond contract has an interest rate printed on it, where we promise our bondholders we're going to pay this amount. It's the stated rate is the most common way that this is referred to, and this is how it's called in your book, but could also be called the contract rate or coupon rate. And this is how we calculate our payments to our bondholders. Okay? Our payments are going to be with the stated rate on the bond. There's also a market rate. So we may issue a bond, and then as time goes by, the demand for this type of bond is going to be different from the amount that we're paying our bondholders. So the market is how much the bondholders are demanding to be paid, and the stated rate is what is being paid. So long as these two things are the same, the market rate and the stated rate are the same, then this is called selling at the face. So we are selling the bond at face value. So that means the amount of proceeds we get from our bondholders is the same as the face amount of the bond. Each bond is going to have a term. So in this example, let's say our bond has 5-year terms. So we're going to pay our bondholders back in 5 years. The face amount is $100,000. So that means they gave our company $100,000, and we promised to pay them back $100,000. The stated rate on the bond is 10%, so we're going to pay them payments. If the bond said annual payments, we would say 10% times $100,000, 10% times $100,000 equals $10,000. If we have semi-annual payments, then we're going to divide that number by 2 to equal $5,000. So we would pay $5,000 2 times a year, and that's still going to be the same 10, just the bondholders get 2 payments a year instead of 1. So here are the journal entries for a bond if it is sold at face value. So the first journal entry is to issue the bonds. This is when we get the cash. So if we have a bond that's sold at face value, then the face amount is equal to the cash that we get, or the proceeds. So that means we get $100,000, and we're going to be paying them back $100,000. Now let's say this particular bond is semi-annual payments. So that's the example I'm going to do here. So that means on July 1 and January 1 of every year, we're going to send the bondholders a check. And we already calculated those payments. They're $5,000 each. So we're going to send them a check, $5,000. That's a reduction of cash. So we're going to credit cash. And we're going to count that as interest expense on our income statement. So that's on July 1, our first payment. Then, come to the end of the year, well, we have to make an accrual because we want to get that second payment on our income statement because all of that 6 months has really passed. We're just not going to pay it until the next day. So the way that we do that is we accrue that interest expense. And we owe it, we're going to pay it tomorrow. And so this is where we pay the payment on the next day. We remove the payment of $5,000 that we owe because now we're writing the check on January 1. So there's some common journal entries for a bond sold at face value. Okay? But we could also sell a bond not at face value. So here's a scenario where the stated rate is less than the market rate. So what this really means, and this is super important, is that the amount that we are going to pay our bondholders is less than what the market is demanding. And so because we're going to be paying less, 10%, even though the market is demanding 12%, we're going to have to sell our bond at a discount. So this is an example of a discounted bond. The face value of the bond is still $100,000, which means that we are still going to pay back our bondholders the entire $100,000, but we're only going to make them pay us up front proceeds that are less than face value. So when you have a discount situation, your proceeds are also going to be less than the face amount. So we might call that selling at 97, or it could be selling at 99 or 96. You just take 0.97 times 100,000, and that's $97,000 in proceeds that they're going to give us. So you would be told, what percentage to multiply to get the proceeds. So that's $97,000 of cash that we're going to get. But we are still going to pay them the entire $100,000 back, so we're going to credit bond payable. The difference between those two things is a discount. And we're going to call that discount on bond payable, and it is a debit balance. Together, these two accounts are called the carrying amount of the bond. So the carrying amount of a bond is the bond payable minus the discount is the carrying amount. And so right now the carrying amount of the bond is $97,000. That's how much cash we got. So now let's calculate the payment. So we have $100,000 bond, and it's paying 10% semi-annually. So we're going to divide that annual number by 2. So that's the amount of cash that we're going to pay. Now, because we have a discount here, we can't just debit interest expense. We're actually, in addition to this payment, we're going to remove some of this discount at the same time, which is really also interest. So how we would figure that out is you take the amount of the discount and divide it by the number of payments. So here, since it's a 5-year bond and there's semi-annual payments, we're going to make 2 payments every year for 5 years. That's 10 payments. So you're going to divide the $3,000 by 10, and that equals $300. Every time we make a payment, we're going to remove $300 from the discount. This is called amortization. Okay? So we're going to remove $300 after our first payment, and that increases our interest expense by $300. So in a discount situation, amortization increases your interest expense over and above your payment. And so then you would do this again. At the end of the year, we have to make that accrual again. We won't pay the cash. We'll just put it in interest payable. You'll have the $300 discount, and interest expense will be $5,300. And then the next day, you'll turn around, take the $5,000 out of payable, and write the check. Okay? Now, after we've made 2 payments, let's see how much is left in our discount account. Discount on bond payable. Well, it had $3,000 in it, and then we took out $300 and $300 twice. So we took out $300 once, $300 twice. So now our discount has $2,400 left in it. And over the next 4 years now, so when 1 year has passed, over the next 4 years, we'll remove that all the way down to 0 until there's no more left. Okay, that's a discount. This could also go the other way in that we have a stated rate. We're going to pay those 10% payments that's greater this time than what the market is demanding. So we already printed on the bonds, we're going to pay 10%. But The market's only demanding 8, so we are actually paying more than the market is demanding. So we're going to make our bondholders pay a premium for this bond. And so that works out where we might say this is sold at 102 or 101. Our proceeds would be 100,000 times 1.02 or 1.0 whatever it is to get 102,000 in proceeds. So that's how much cash we're getting for this bond. But we still are going to pay back our bondholders that same $100,000, and we get to keep the extra 2, which is essentially interest. So the difference here is going to be a credit difference this time, and we're going to call it premium on bond payable. And once again, these two things together are the carrying amount. But because premiums are on the credit side, you would figure out premium situations by adding the premium to the payable to get the carrying amount. And that's because they're both credits. So that's the issuing of bonds, journal entry. Now let's do our first interest payment. So we know that we're going to pay that same $5,000 of cash payment, calculated using 10% semi-annual payments. And let's calculate our amortization of our premium. You take $2,000 of a premium, just like you did your discount, and divide it by number of payments. So we still have 10 payments here. So our amortization for this scenario is $200. So we're going to remove $200 with a debit. So we started out with premium on the credit side. That's where it's supposed to go. It's normally a credit for premiums. To remove it, you're going to debit that account. So that makes your interest expense go down, less than the payment. So in this scenario, premiums reduce your interest expense, don't they, by the amortization amount. So after this payment, our premium account started off with $2,000 in it. We just took out $200, so now it has $1,800 left in the account. And then at maturity date, in either scenario, discount or premium, the premium and discount accounts will be gone. They'll be zero by the time the bond matures. So all that's left on the books at that point is the $100,000 bond we got to pay back. So when we pay it back, the journal entry is to remove the bond payable and to write a check to our bondholders for the $100,000 that we owe them. Okay, so the last thing I want to cover is redeeming the bond. So we may not wait all the way till maturity. We may redeem it before maturity. So in that case, when we redeem the bond, we may have a balance in our discount or premium account at that point. So there's 3 steps that you want to go through when you're redeeming a bond. Here's a scenario. We have a $100,000 bond face amount. It was sold at $95. It's an 8-year bond, semi-annual payments. And because this is sold at less than face value, this is a discount situation, okay? So what happens if we redeem it after 3 years of having this bond? So essentially 6 payments have passed. So the first thing that we need to do is figure out what's the balance in our discount account. So that's the first step. Well, we have a bond sold at $95,000, so that's 0.95 times 100,000. That's how much proceeds we got, 95. So the difference between these two things is our discount of $5,000. Okay, so take 5,000 divided by number of payments. Well, if we have 8 years, two payments a year, that's 16 total payments. So at every payment, we were going to be amortizing $312.50 every time we sent our bondholders a payment. Well, 6 of those have passed. So that's $1,876 that has been removed from our discount account. So let's figure out what's the balance then. We started with $5,000 and we removed $1,875. That's $312 6 times we took that out. So that means we have $3,125 left. That's step 1. Step 2 is we need to figure out what's the carrying amount of the bond now. Well, since we have a discount situation, we're going to go with this formula. So if it had been a premium, we would add the premium to the face because they're both credits. But since this is a discount, discounts are debits, we're going to subtract the discount from the face amount to get the carrying value. So the face amount in this example is $100,000. We're going to subtract our discount balance calculated from step 1, and that leaves $96,875 of a carrying amount. Okay? Step 3, what's the gain or loss? Okay, well, you need to know how much the bond was redeemed for. So let's say in this scenario, the bond was redeemed at 101. So that means we have to pay back our bondholders a purchase price to purchase the bond back. And we purchased it for 101. So 1.01 times 100,000 is cash of 101,000. That's called the reacquisition price. So we're going to pay them back 101,000 and subtract the carrying amount from step 2, $96,875. So that leaves us with $4,125. Now, this situation, this is a loss because we really only owed, I want you to think of it as the company has the loss, the bondholder had the gain, okay? So we had to pay back 101 to get the bonds, but we really only owed them 96. So we paid an extra $4,125 to get the bonds back. So this is a loss to the company, and the bondholders got extra, so they have the gain. The journal entry would look like this for redeeming of the bond. We would remove the bond face amount of $100,000. We would remove that discount balance and the cash we had to pay them to get it back. And the difference is going to be on the debit side to balance out $4,125. So losses are always going to be debits, and if it had been a gain, our gain would be on the credit side. Okay? So super long video. I know that was a lot of information, so you might want to watch it in pieces. We'll post some practice for you to do before you do your homework, and then just let me know if you have any questions.